Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL, and certification from NASM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Welcome to the Quick Podcast, brought to you by Dyota Solutions Private Limited, SEBI registered investment advisor. License number INA 000007216.
Good evening, friends, and thank you for dialing in to this webinar. And as you can see from the red tie that I'm wearing, it indicates that in Hindi, "Ye lal rang kab mujhe chhodega," right? There's a song. So clearly, we are under the throes of a massive correction phase, similar to what we saw in the first few days of COVID, similar to what we saw in the first few days of the global financial crisis and to the currency crisis later. I think at all of these times, the market has reacted very strongly. Now, this particular crisis, let me delve into that. You all know the numbers of how much the market is corrected and all of that. So I'll not repeat that for you. I'm sure all of you are looking at your portfolios and at the markets and experiencing the pain, right? So the point is, first of all, let me address the issue that a market which had not reacted so badly to a direct impact on India, which was the Operation Sindhu, has reacted so badly on something which is totally unrelated and thousands of miles away from India, right? And the answer to the lies that in our interdependency on the world for one critical commodity, which is oil, right? And this particular war is taking place in a zone where our oil supply is impacted. The Hormuz Strait, 21 miles wide, 33 kilometers wide, is the place where 20% of the world's oil supply passes through. And it is also a place where, at the present time, just before the war, 40 to 45% of India's crude supply was being sourced. It used to be as high as 65% in the days when we were importing from Iran, before the sanctions came on to Iran, right? So our dependency has come down, but it's still there because we get gas from Qatar, we get crude from Saudi Arabia, all of which has to pass through the Hormuz Strait. So while the 20% of impact on the world oil supply is reflecting in the world oil prices. Now remember, the world oil prices are not a reaction to India's suffering. The world oil prices are a reaction to what the world is going through, because the USA, which is thousands of miles away from the zone of conflict, the local gas prices in the pump station have shot up. So nobody is immune from that. So what the oil price reflects, and today as I see now that's it's around 110, 111, right? What it reflects is a severe impact to the world in terms of energy costs. So clearly there is going to be an impact on all petrochemical related industries which are using crude all over the world, wherever they may be. If I may draw your attention to the fact that just a few months before, oil was hovering between $65 to $70. If you assume 70 as a base and 110, we're talking about a $40 increase. 40 divided by 70 is 60%. So the world over, petrochemical input industries are facing a 60% rise. The impact on various sectors will vary depending on how much they use. Airlines use 40% of the operating cost is aviation fuel. Paints, tires, you name the industries, all of them. But also for the world, one of the reasons why this is that it affects food supply. It's not just about oil, because urea, right? The NPK fertilizers, phosphate, all of those also depend on the naphtha, which is a crude derivative. So the implication of this is not just on an oil thing, but food costs are probably going to go up across the world, which means inflation is going to go up across the world, which means interest rates will be hiked across the world, right? So this is going to have a cascading effect. And that's why the reason is that the sell-off has happened worldwide on equities. Some markets more, some markets less. US is a net exporter of crude, so positivity on the energy stocks there has compensated the fall in the user stocks. So various countries have were reacting differently to this in terms of that. But overall emerging markets, if I look at it before today's correction, I have not updated to today's correction, so that Indian market had fallen by about 7%, but world emerging markets had fallen by 10%. So before today's correction, actually Indian market had not corrected the most. Emerging markets had corrected much more. Because why? Because the energy is the biggest input for AI. So energy costs go up, all the AI related markets like Korea and Taiwan have naturally got hurt much more, right? So clearly I'm trying to explain the cascading impact of this war on various parts. So Korea, Taiwan, and those markets also seen massive correction because they're primarily AI semiconductor driven, where power is a major resource and power costs are naturally going to go up. So the point is, of course, is for India is that there is a double whammy. So first is the impact of $105, $110 oil price on a multitude of economy related events, right? Which is the current account, the trade deficit, the current account deficit, and naturally the fiscal deficit. So you would have seen the news today that when it comes to petrol and diesel at the pump levels, India, unlike in the US, which is a free pricing model, has the ability to control the prices, but ultimately the pain has to reside somewhere. Now, three options are there for this pain, right? One is pass through this to the consumer, which means retail inflation will go through the roof, governments will become very unpopular, and as if you've studied political history of India, every elections one lost by the incumbent has always been because of inflation. Okay, so first is if that happens, I'm not saying that's going to happen. The second is that government decides that we will absorb it. How? Through excise duty. So you would have seen the news today that they've dropped the excise duty for diesel from 10% to 0 and for petrol from 13% to 3%. So the government is taking a 10% hit to that extent, protecting the retail consumer from the inflation. But what they're not doing is not protecting the corporate consumer from the inflation, right? So paints and tires and those will naturally suffer the higher cost of food inputs, and the cost of paint and the cost of tires will come through in an indirect form to customers as a retail inflation. Now, this factor, the third aspect is if oil price at this level, the government has taken this decision, if oil goes up further, what? Diesel is already 10. They've already reduced it to 0. So then the choice arises the government on slapping this on the oil marketing companies. Years ago, if you remember, there were oil bonds created. The oil companies were asked to take the hit, and they were financed through oil bonds, which have recently matured. So there are again multiple ways of getting the companies to take this as a burden. So naturally, those related companies will suffer in the stock market because of the earnings impact. But overall, on all of this, even those oil bonds ultimately have to be financed by the government. So the fact is then the concern arises on the fiscal deficit. Government has targeted a 4.4%. How far is this oil related impact? Now that's where I come in. I just mentioned to you that Indian market is corrected less than other emerging markets. That is if you take the rupee performance of the Indian markets and the respective currency or maybe dollar performance of the emerging markets. But what has parallelly happened to India is the rupee has weakened. It's now touching the borders of 95, right? So the rupee's weakening means that for India, that's a double whammy. Because not only is the landed price of oil not 110, but it's 110 into the new currency. So the impact of that is a cascading impact. But all imported items, non-oil related also will carry an imported inflation component, and the fiscal deficit and the current account deficit and the trade deficit. All of them will suffer this double whammy of an oil price plus a rupee depreciation. Why is the rupee depreciating so much? One is, of course, FIIs have been massively selling. As of date to date March, they have sold 1 lakh crores, whereas in the month of February, they had actually bought 30,000 crores. I think January they sold 30,000 crores. So effectively, if you see this whole last year, what they sold, perhaps they're selling now as bad as that. So the massive drawdown of dollars by the FIIs in the process of pushing is weakening the currency. Second is the currency market is also reading into the future of a sustained oil price on India's imports and factoring that today. Like the equity markets factor the future, The oil markets also tend to factor the future. The third aspect is, when I said that equity markets worldwide are correcting, what's happening? Where is that money going? They're correcting, somebody is selling, somebody is booking profits. That money is going back to the US. Because today for the world, the safest asset is a dollar denominated debt asset in the US treasuries. So US's rating is not as sound as before. Still, nobody expects the US to default. And you've seen that in the period of this month, the 10-year US yields have shot up by 20 basis points from a 4.26 to I think 4.46 or something I saw today. So that's also because the Fed has also conveyed a hawkish hold. So they have not said interest rate hike yet. They said we are holding subject to inflation. But if oil sustains at this level for another month, the Fed also may start looking at it as an interest rate hike. But I will hold my horses on that. But I'm just trying to tell you that this flight to dollar has caused the dollar index against to cross 100. Remember, it was hovering at 90 levels some time ago. So the dollar index strengthening has had its pressure on the rupee weakening. So rupee has faced a triple whammy. One is FII outflows. Two is the future impact of a sustained oil on trade deficit being reflected in a rupee has to weaken kind of thought. And the third, of course, is the dollar's actual strengthening. So as a Indian economy, then we are faced with two whammies, which is the currency. So that, if you look at it now, finally, I'll address one more market before then I come back to our Indian markets, which is the gold and silver markets. Traditionally, gold has been labeled a safe haven. For entire existence of the gold markets, it has been a safe haven. But what has happened to its safe haven status? So first thing is that you realize that the rise of gold rose in a non-geopolitical time. I mean, the Russia-Ukraine war was there, but it had a very limited impact, right? India was only again influenced by that, but we were buying the Russian oil. So the impact of Russia-Ukraine war was felt for a very short time in terms of the market, immediate sharp correction in India. But what I'm trying to say is that the rise of gold is not being correlated to a geopolitical strife. Rise of gold was linked to a de-dollarization move by emerging markets of the world who were blindly placing their faith in dollar assets with their surpluses, who felt that the US, with a rising fiscal deficit, with a man like Mr. Trump in charge who was uncertain, the freezing of the Russia's dollar deposits by the Biden government meant that on a tariff war worsening, they were worried about their assets if they are too much in dollar. So all of this meant that roughly 1,000 tons per year was the acquisition of gold just by the central banks of the world at the cost of the dollar, right? Second, at that time, right, over a period of time, we've seen waxing and waning, but general feeling was that US economy is in a slowdown. The tariffs would again impact that growth. And so a rate cut was planned. And so the dollar was weakening. And so it made gold an alternative, attractive asset class. So the rise of gold started with these, and then typical retail and HNI behavior. When they saw gold prices rising, the ETFs across the world, gold and silver ETFs, saw massive inflows. So these were all driven by the choice of an alternative currency. So gold took on the role of an alternative currency over the past few years, giving fabulous returns. And so returns begets more money, and more money begets more returns. The virtuous cycle, if we may call it, stepped in. So when this particular geopolitical crisis started, for people then to go and say that I will now shift from equities into gold, when gold had already run up so much, always any safe haven thought comes at a price. There is no unlimited good in life. Everything that is good, there is a price beyond which it is not good. Okay, that's the rule of law. You can't say that it's an unlimited good. For everything, there's a price to pay. At that particular price, it's a safe haven. So gold had given up that kind of a safe haven, as in safe from volatility, safe from corrections, that thing in this crisis time. So it was no longer a natural flight to safety choice by institutional investors, number one. Number two, what happened is when this equity markets gets corrected, and I want to draw your attention to what I'm going to say now, because that's what I want to correlate to what's happening in India, is that world across currency markets, the gold market, equity markets, the debt markets, India is an exception to the extent of local people don't do what I'm saying, but across the world, And as NRIs, if you're aware, with how private bankers deal, the entire world deals on investment as a leveraged investment. In abroad, if you have $20,000 to invest, your banker will take that $20,000 into a fund. The fund will borrow 80% money and put it in, and then he'll tell you, I'll give you so much returns, because 1% rise translates to 5% rise in a leveraged buy, right? So a lot of the buying into gold and of course equities and every other asset class was through leveraged investments. People are greedy. If I believe gold prices are going to rise by 2%, I want to make 10%. So I put in 20% of my money and it goes up to, then obviously, the answer, right? Your 100 rupees becomes 102, but you only put 20, but you got the gain. Because 80 you pay to the bank, you pay more 1.5 rupees as interest. The rest of it is on your base capital of 20. So the returns are fabulous in the leveraged. The opposite is also true, right? When things unwind, they hit you badly. But in this particular instance, what happened was that the leverages started with the equity crash, right? Now, when I have leveraged and bought equity, and a margin call is being made by the lender saying the equity price is crashed, I need money to cover your portfolio. What do? You go and dip into that which has made you a lot of money, sell that and put it in. So gold, all the leverage buying of gold got unwound, and actual gold also got sold. Gold investments got liquidated to meet the margin money component on the equity side. So that's why gold has been through this very unusual correction, and silver even more, because silver was gold plus equity risk. Because why? Silver is linked to industrial use, right? 40 to 45% of silver's use is industrial use. So when you get industrial use, then you go through cyclicals, right? So silver had a fabulous rally because the story played was not only a precious metal safe haven story, but also a shortage of production, supply, demand issue, and industrial demand rising, widening the demand supply gap, and thereby pushing the prices up. But when the reverse happens, an industrial asset like equities falls even harder than a pure safe haven asset. So silver is unwound even faster than gold. So that's what I said was this leveraged buying, the unwinding of it, has exacerbated what was a virtuous cycle into a vicious cycle across the world, right? So why I explain this? Just to explain what happened to gold and to you. So now we come to India. So what's happening to India? So let me again put back you to the fact that obviously this month alone, since the war began, I think I saw the data as of today, about 92,000 crores has been sold by FIIs. So that in itself is enough to have caused this kind of a this thing, right? Because domestic institutional investors have bought 1,12,000 crores. So pound for pound, rupee for rupee, they have bought more than they sold. Now, why is then the correction? If two big flows are matching, it's because the domestic guys are smart. They put a buy order with a price, and only when the FII comes down to that price that buy order get executed. They are not fools to go and buy at the prevalent market price of a product. So they want to sell HDFC Bank shares. If it's quoting at X price, the DI will quote to his broker saying, when it comes to X minus 20, I'm a buyer. So the FI will keep hunting, and when it comes finally doesn't buy a buyer, he sells it at X minus 20. So the DIs have been buying after the fall, hence the fall. But then unfortunately what's happened, the next day it's fallen even more. So effectively they've also been catching falling knives. So the blood on the street is actually also blood on the hands of all these people who have invested in this period, right? So where I am then coming to is that despite the fact that there's been 90,000 crores of sales, you need to understand why the market reaction has been so severe, because it's a function of multiple things. Okay, take today. I don't know, the data for today is not yet out, maybe, but I was looking at the data and I found that 35 to 40% of the FIR volume in this month. Day to day, it has varied. I think at a low was 30%, high was 40%, somewhere between the two, is that the amount of money that has been buying the stocks, right? So let's take 40 for an example. So 40% of the FI money has been buying stocks, 60% of the FI money has been selling stocks. So net what you see as is 1 lakh crore or 90,000 crore is that 20%. 5 times the volume has been traded. The market is corrected because 60% of those have been sellers and only 40% buyers. Park that thought of these buyers for my subsequent discussion thought when I come. But these sellers, why are they selling? They are selling component of three things. So first is a FII who had entered 3 years, 4 years, 5 years, 7 years back, an alternative investment fund. The fund is maturing in the next 3 months or 6 months. He has to return the money to his investors, right? So what does he do? He says, I don't want to take the risk that in 3 months the war will end, the market may go down. He liquidates it today to protect the gains he has got so that at least he can give some decent return to his investors of the close-ended fund. So that's one component. The second component is an active manager who takes a tactical call. There's a MSCI Emerging Market Index, and he is investing with that as his benchmark. India's weight last that I saw was about 13%. But if he feels that India is going to go up, he has the right as an active manager to overweight that benchmark and take 15 or 16%. But if he has a negative view of India, for the tactically, he will take an underweight position. So active fund managers who run open-ended funds will keep changing their tactical overweight, underweight. And in this period, because 85% of India's oil is imported and the currency is also getting impacted by this oil plus the other dollar strengthening, they are viewing India as a high-risk space. So let me go underweight on India. So instead of a 13%, he takes a 12 or 11 or a 10, depending on his fund manager. So that's another problem, as unwinding his position from the old 13, 14, 15%, maybe to 11, 12. That's the selling. But I believe that though these two are potential sellers, their component is not that great. Right? Of this total sellers, I would attribute this to 20, 25% or 30% to be these kind of sales. The bulk of the selling is happening from the vultures. Who's the vulture? I'm talking about vulture in a sense that, vulture assets, people go and pick up distressed assets and then try to make a good profit of them. They are only driven by their profit. So what I mean by vultures here is the short sellers. Short seller actually looks for a disruption or a disaster to make money. So he shorts the market not because he's panicking, because he knows that, he's predicting or he's thinking in his mind that everybody else is going to sell India. So I know the price is going to fall. So I'll short it today and later I can buy it back tomorrow and make a handsome profit. So what I'm trying to say is, even in this whole milieu, there are greedy people who are actually acting to make money out of this bad news. Now you might, like Hindenburg was a classic name which comes to a known short seller. You might say, no, they are bad people. No, they're not bad. Ultimately, they are also managing money for their investors. At the back of the money, they have investors. They have told them, we'll use short as a very strong tactic to deliver returns to you. There's no love loss. I mean, it's not that they hate India or like India. It's not that you should hate them or like them. Because the same people, when India bounces back, will come in and take long position in India. Because he wants to make money from India. But they are the people who exacerbated these things in the F&O market and hurt the market. Right? So one of the reasons India has suffered a lot in this, in dollar terms, is because of these hedge funds who are one of three: maturing funds, actively managed funds underweighting India, or actively shorting the Indian market to make a profit out of it. Right? So that's essence, and that's why whatever DI buying, right? DIs generally don't play in the F&O market. DIs are, while now there's an SIF product which allows a limited amount, but it's 10,000 crores in volume today. It's not a big enough. So yes, certain AIFs India can short, certain, I don't know, PMSs whether they short, but the bulk of the mutual fund industry, which is 50 lakh crore industry total, if you look at equity plus hybrids, is not in a position to short the market. So they can't counter this. They can only go cash market purchases. So all this shorting related selling is exacerbating and making the fall much, much worse. Right? So to come to the point then, Yes. So these shorters will continue to short till they perceive that the war is going to continue and the oil prices are not going to come down. So how long will this pain last? Well, it has to see, and that's why on days you've seen relief bounce back, because these shorts have got covered on the days that the market has got some positivity. They have to cover their shorts, right? They want to cut their losses at that time. So these temporary, they are bear market rallies, you can say, because we're clearly in a bear phase right now, no doubt about that, are just, just happening on those odd days when there is some good news and Trump says some tweet or something happens. Right? But otherwise, this current scenario is something that as long as this war is going to continue, and it's not that oil prices need to be seen to rise further, because even at the current $110, India has a 60% additional cost burden on all the economy as well as the sectors using petrochemicals. So this is real damage. Temporary maybe, because oil prices when the war goes on will come back, but immediate impact on the EPSs of certain companies is going to be negative. To some extent, the market has already put a consensus estimate on that correction. They're still working the data because it's hard to, the rate at which oil has been falling, they would have initially done it at 85, then they would have done it at 95, then they would have done it at 100, 110. So market believes on consensus, right? So don't worry that the earnings season, when it comes out and this bad news comes out, market may not react that badly because it's already in the consensus estimate. So understand that market trades on expectations versus reality, or market has already brought down the expectation on the earnings for impacted sectors, right? So not to worry that, oh, there's another set of bad correction awaited when the quarterly earnings coming. No, because market is already knows that it's going to come. So it's already taken, right? They say that, no, buy on the rumor, sell on the fact. So whatever they know, the expectation is already in the price. So I'm not unduly worried about what these numbers actually turn out to be, because the way the market is corrected, it is already factored in the drop in EPS expected. Right. One other question which I had been people are asking me, and so I thought I'll put it on here, is, sir, our market is corrected so much. 26,300 lifetime high was somewhere there. We are at 23, 30, going below 23 now. So isn't that a huge steep correction, and aren't our valuations now more reasonable for FIIs? Like I said, that before today's correction, Indian market on a dollar term had corrected 13% versus emerging market corrected 12. So we have corrected only 1% more than emerging markets. So why I'm saying this, our relative valuations are still not cheap. While India has been hurt more than other markets, that differential is not that great yet to make our valuations on a relative basis. Yes, against our 5-year average and a 10-year average, we are definitely looking healthier. But on a relative valuation to premium to other emerging markets, we are still not a value market. We're still at around 55% premium to the emerging market. As of March 31st, we'll probably get a more accurate data, because these collections and correct the data evaluation happens at month ends typically. But my estimate is we are at about 55% roundabouts there in terms of emerging market. So we are not cheap, but we are below our long-term average even there. If I remember, our long-term average premium of the emerging market is about 64%. So we are cheaper to our own long-term average of the premium, but we are not still at a discount to the emerging market. No, not by chance, not by far. So we are still not cheap from an FIS perspective, right? Now I mentioned that there's about 30 to 40%, depending on the daily thing, people who are buying. Part of the buying is from hedge funds covering their shorts, because what they sell in the options, futures or options market, they have to buy in the cash market. So part of this is buying when they cover the shorts, and then they re-short it later. This part of this buying is by long-term pension funds, insurance funds, who are continuing to buy through this fall. Why? Because they've already built a portfolio on India with a 10, 15, 20-year outlook. And while they recognize that there is damage in the short term to everything surrounding in India, from the fiscal to the inflation to the expectation of rate hikes, so EPS growth, everything, they expect that India will bounce back. It may take a bit of time for oil to come back to its earlier levels, but our growth story is largely a domestic-driven growth story. So to that extent, India, the worst-case scenario I've seen is for so far on a projected growth is about a 1% drop in our GDP for FY27. There are still some people who are still put it at 7.1 for India. I think S&P now, but OECD I think has dropped it. But what I was saying is, in the short run for FY27, that is next year, let's say a 1% cut in our GDP. We were earlier expecting 7, let's say it's 6. Let me take an extra step and let's say it becomes 5.5. We will still be the fastest growing country in the world. Because the next closest, fastest growing major economy was China at 4.5%. China will also get hurt by this growth. Their 4.5% will also slip. So at 5.5% also, India will be the fastest growing economy. And the strength of our economy remains our domestic. The domestic will suffer. No doubt about that. I'm not denying that. But whatever it is, we are more insulated. Right? So when oil price comes back to a reasonable, stable level, there are people saying that it may come back and settle around 80, may not go back to the 60s, albeit 60, 80 at 80, the economy will readjust, but the growth path will come back. Okay. This year, fiscal deficit might be a challenge, but like in COVID, when our fiscal deficit went up very dramatically, world will recognize that this was a particular situation under which our fiscal deficit had to slip, and they will pardon that from a rating agency perspective, that as long as the future direction again looks to bounce back. So on a one-time, rating agencies are not foolish to say that, oh, you've been impacted, your fiscal down, I'm downgrading you. No, that means they have to downgrade the whole world, right? It's all again relative. So there'll be a certain amount of understanding of our temper. Like during COVID, did we suffer a downgrade despite our so bad fiscal deficit? No. So people recognize that in times of such situations, the situation goes out of hand. As long as after that you're not profligate in terms of your spending, and you're spending on capex as you were doing before, and managing your budget decently, your rating will remain on track. Okay, so have that faith that fiscal deficit slippage doesn't mean the end of the world. It means that you have to tactically do something to protect your country at that time. That's the way, right? Now, having said this, so that's why the return of the FII in terms of the shorter term, the hedge funds, the actively managed funds, will take a bit of time till the clarity comes around the end of the war, or at least wild thought is the war doesn't end, but US takes control of the Hormuz Strait along with Saudi Arabia. Then also oil prices will come down. I'm not saying that's a possibility. I'm just pointing it out that the US is also being hurt by the oil prices. And whatever Mr. Trump's actions also are a direct consequence of that. So it is in his interest also. It's not in Israel's interest though, because Israel has completely different goals from the war. But US's interests are in controlling the price of oil, which will happen only if there's a control over Hormuz Strait. So that's a possible solution which may come through, that a primary war on Iran do, but they will, the 100 kilometers around the port, around the Hormuz Strait land part of it, US takes complete control of it with the landed troops. God knows, with Mr. Trump, anything is possible in terms of thought. Then oil prices could crash because they are now promising safe passage to ships through the, right? So anyway, all that is in the realm of speculation. But what I'm saying is that for active managed funds from the foreigners to come back, it's going to take a bit of time. Domestically also, DIs have blown up a lot of their cash, 1,12,000 crores. And of these, the mutual funds are getting roughly 30,000 crores through an SIP book month. So they're not going to get 1 lakh crores of inflows sustainably. So even the DIA buying may have to taper down over the next month, because they were thinking they've used a lot of their dry ammo here. They still have it, because if you take the mutual fund industry and say 5% cash over 50 lakh crore industry, it's still 2.5 lakh crores, right? But 1,12,000 crores is 40% of the 2.5 lakh crore. So today we are in a situation where even DIs are doing sector rotation to buy what they feel has a greater future. So mutual funds are also doing that. That's why you see that even the mutual fund data which comes in, 60% to 70% of mutual fund money is buying, 25 to 30% is selling. But they're not selling to leave India. They're selling to one sector to buy another sector. So there's a sector rotation happening. That's why DIA money also shows buys and sells. They're just repositioning there. They're booking profits on sectors like defense, where they feel there's been a good run-up. They're booking profits on sectors like PSU Bank, where there's been a good run-up. And then buying something else which has corrected a lot and maybe they feel better. That's fund manager to fund manager, that variation with that. So another point which I now want to address to close out my short speech here is that from a portfolio perspective, right? What I want to tell people is that you are looking at a correction which is broad based. The worst 1 month returns, you see the best performing versus the worst performing sector. The worst performing sector is down 13%. The Nifty is down 9%. Mid and small caps are down 7 to 8%. And some sectors are. So for you to now go and say that I will buy a sector which has corrected a lot because it will bounce back a lot, or as a safety oriented, I'll buy that's not correcting so much now, it's a safer sector, I'll buy that. Both are hazardous. Okay. Why I'm saying this is what we are suffering today is a sell India on rise from the fires. So every time there's a small rally, they are booking more profits, right? The active managers there. So overall broad based things are being sold, and no amount of fundamental thinking that an oil related sector will correct more, whereas an non-oil related sector will correct less, has been thrown into the winds, because the banking sector, for example, has suffered the most. Why has that suffered the most? I mean, somebody took a call and said, no, I'll save, banking is safe from this oil related issues, and I put my money in banks, and then you got hurt most. So the hazards of picking a sector, I want to point out, and specifically why has banking fallen? One, profit booking by DIIs to buy other sectors they feel. As a fund manager, he has a right to take tactical calls. He's made a lot of money from his investment in banks. He wants to book profits, is one. Second aspect is that I mentioned short sellers. The short sellers are selling what? The two most active shorts are in Nifty futures and Nifty bank futures. So Nifty bank, by virtue of being 35% of the large cap index, suffers this shorting more. So it's corrected. That's the second reason. Third was midway through this war crisis, we had the HDFC Kand, where the chairman resigned and there was a center of nervousness, not only around HDFC Bank, but around the whole banking and financial services space, which caused some nervousness in the Fed, and they took stock specific either shorting action or liquidated their positions, right? So these are a combination led to that, but nobody anticipated that when the war began. So it's really hazardous to do. So my suggestion is that from your portfolio perspective, don't make any sectoral change because of the war first. So then what to do? So my suggestion here is based on two things. One is your term outlook. When do you need the money that you have already been investing? Okay. Do you need it in the next 3 to 6 months? Or do you need it for long-term planning, which is 2 years, 3 years hence? First, I want to give a solution for based on that. Second is based on your own risk appetite, right? Are you aggressive? Are you moderate? I'm not going to take conservative because a conservative person probably won't have come near the equity markets. Once you come into equity, I would classify you either as a moderate risk person or a. So based on these things, right, I would put a typical BCG matrix box here and say that if you're moderate and you have a need in the near future, then it's wise to move your money into a liquid fund or arbitrage fund, because you shouldn't take the risk of that event for which you had saved being further impacted by a further rise in oil, further correction in markets, whatever. So moderate risk, short-term oriented. And you're short-term not because you're a short-term thinker, it's because you put your money 5 years back with June or September 2026 as the time you needed the money. You are a long-term investor, but the long-term has now become short-term because of the balance time to your needs. So if you've done a goal-based planning and doing it, then it's wise to move it into a liquid fund or an arbitrage fund for the time being. Okay, that's for the moderate. What if you're an aggressive short-term, but your time has come? Same solution. Is it aggressive or moderate? Doesn't matter. If you need the money in the next 3 to 6 months, it's wise to park it into a safer investment avenue. Okay, right. Now you're a moderate, longer-term investor. Right? Do nothing. Keep quiet. Do not panic and sell. Do not sector rotate. Don't do nothing. Right? Wait. This too shall pass. Time will take care. India will come back. Just have to be patient. Right? So there's if you're familiar with Hindi and you've seen this movie Dhurandhar, I'll take a dialogue from that. Nazar and Sabr, which is focus, stroke, vision and patience. So these are the two things you need, right? Nazar and Sabr, which Madhavan's character there, Rajit Sanyal, says that take that as your philosophy is what you need in this time, right? And if you are an aggressive investor, right, then what do I suggest? So again, another Dhurandhar dialogue from the first Dhurandhar 1 movie, slightly modified by me, right? The interval block there, this line comes up from Ranveer Singh, the hero. It says, घायल हूं इसीलिए घातक हूं. So घायल means wounded, घातक means fatalistically attacking. Right? Ghatak. So he says that. What I mean is that what I wanted to say is India is ghayal. Our markets are ghayal. But when we bounce back, we'll bounce back with a vengeance. So ghayal hai, isliye ghatak तरीके से वापस आएंगे. So as an aggressive investor, I would say go back on 28th March with Kishore and with Kaushik. What was your portfolio allocation as of 28th February or 27th February? 28th was when I think Israel attacked. Get the dates right. What was your portfolio allocation then? My suggestion from that day, I don't know, I didn't want to talk before, I may have said this then also, is to buy 1% of your free cash flow in that same proportion every day of the correction. So since then, I think we've had a month, but month is 20 market days roughly. So if Nifty has corrected 10%, broader market, let's say, has actually corrected less than Nifty. So let me take this 10%. So which means if you had been following this, you would have deployed 20%, because 20 days has happened, of your free cash flow at a reducing price of your existing portfolio. So when you then look 5 years hence, right, your cost of acquisition on your overall portfolio, depending on how much free cash and so what that 1% day means to your total allocation, varies from person to person. If you're fully invested and put 95 in the market, you only have 5% on which 1% of that 5% you can put. But if you're otherwise had a lot more cash, that 1% rule still holds good. So you would have averaged that cost. And when India bounced back in a Ghatak way, you will get much better returns than if you do nothing. So if you're an aggressive investor with the thought process that ultimately India's will recover, time frame is uncertain, whether it's V shape or U shape is uncertain, but it will recover, then keep the faith and stay staggered, regularly putting in 1% every day into the market in the same proportion is what I would suggest. So with that, let me close out this brief outlook and update on the markets. And now if there are any questions that you would like me to address, or if Kaushik and Kishore would like to add their 2 bits to it, then happy to hear them too.
Kaushik, it is still echoing. Sir, if you just click on that question,
I've clicked it. What I see is your Q1, that is what you have put up. So it is a tough time for investors. We are currently seeing a rare everything sell off, where the traditional safety of gold and bonds is being challenged by a massive spike in oil prices. I think I've addressed this question in the course of my talk. I think that's done. Then second is with commodity war, equity and commodity taking a beating. Where and how does a retired family with 3 crores earn their 2.5 lakhs per month? Inflation adjusted. So I hope you're doing it through an SWP, in which case the 2.5 lakhs shouldn't get affected. If you're, however, depending only on returns to do that, it'll get affected. But if you're doing a systematic withdrawal plan to meet that 2.5 lakhs, this correction shouldn't affect that. And so I'll leave that answer to Kishore and Kaushik to handle. And that's the 2 questions I see here. Is there something else? I don't see anything else here.
give me a moment, sir.
Because Kaushik said this is 10% withdrawal rate on the portfolio. That's all I see. Okay. There's a fine line between being a patient investor and being a stubborn one. How can a retail investor audit their portfolio right now to know if they are holding on to quality that will bounce back, or just hope trading on a sinking ship? when you look at the current everything sell-off, what is the one data point of the historic value that gives you confidence that the Indian market structure story is intact? So I'll split it into two questions, right? The first question, the final line, how can a retail investor right now know if they're holding to quality that will bounce back or just hope trading on a sinking ship? Well, you are in the camp that believes that India is a sinking ship. I have no answer for you. Right? First of all, right, India is not a sinking ship. It is a ship which has been damaged for the time being by a temporary sharp spike in oil. On what basis is a sinking ship? A country doesn't just disappear into the ocean. Country survives and grows. India's biggest strength is its domestic consumption, its demographic dividend, its youth who are going to work. Yes, there will be an impact. Nobody is saying that we'll come out with flying colors. But look at it that when there is liquidity, the typical story behind crises and recovery has been the response of central bankers to crisis, which is to pump more liquidity into the economy. It's repeated time and time again from the global financial crisis to the COVID crisis everywhere. Even this crisis will see a massive infusion of liquidity by the central banks in the world when the economy, if it's going to go into a recession in the world, and that liquidity will find its best level, which will seek the fastest growing country in that depressed world, which will be India at a 5.5% growth rate. So please don't believe that we are in a sinking ship. The markets are sinking, not the economy. So what is that ship? The ship is not your market. The market is dependent on the economy. So there is no hope trading here. Now the quality of your portfolio, I don't know. I don't have a visibility into the quality of your portfolio. But if you have been listening to Kaushik and Kishore and doing, your entire portfolio is 100% quality. So I don't think that portfolio I'm worried about. If without them, you've been buying some hope stocks. Well, I can't give you an answer. But let me just say one thing to you is that are there going to be companies which are going to be permanently destroyed in terms of their revenue stream because of oil? I would say no. Every company will face this hit. Over-leveraged companies may collapse and they may be bought over by somebody. But like I said, that's a penny stock situation and I can't advise you based on that. But by and large, a diversified portfolio will bounce back. So I think that if you have got an advised portfolio from Kaushik and Karthik, I would say, Kishore and Kaushik, sorry, you don't need to worry. It will bounce back. Just stick at it. And what I just now said about the 1% rule, if you're aggressive, or the 0% rule, if you're moderate. That's it. Keep quiet. The next part is that when you look at the current everything sell-off, what is the one data point or historic parallel that gives you the confidence that the Indian market structural story is intact? So what do you mean by a structural story? Structural story happens because of two things. One, the fact that you are the youngest population in the world. We're adding more and more young people. And over the next 2 decades, India is going to add 15 crore people to the workforce. Unalienable fact. Because these people, 15 crore people are already born. They're just kids running around on the streets. So it's not fresh production that you need to create in the maternity wards of the country. Okay. So whereas China is losing 11.5 crore people in the same period. Already born, going to go out of the workforce, either by dying or by just getting old enough, too old to work. No other country. Indonesia is the nearest with 1.5 crore. We are at 15 crore. So what I'm trying to say, this is structural, right? Kids already there going to work, being willing to work. They will work at whatever cost is then available in the market. Their salaries may go down, but they will still go to work and they will still consume and they will still do. Right? So first structural story is India's demographic dividend. Whatever. That's just the headline way to explain what I said. Second, what is the structural story? Is the consistent investment in capital expenditure by the governments of India since 2014. Because CapEx has a multiplier effect, the government has been very conscious that ultimately it's economic growth which is going to provide the jobs. I see no change in that because of the oil price rising temporarily. They may put an oil tax on people, right, on the middle class. Yes, I don't rule that out. Education cess came in, this cess came in, COVID cess. So cess could be a cess, saying oil cess for the time being because India is passing through COVID-related crisis as the Prime Minister has now pointed out to the world. So there may be an income tax which comes on, which means the rich pay the poor or the middle class pay the poor. But Where is that money going to go and do is that the government's focus on capex is going to continue for the foreseeable future. So there is no structural damage there to the economy. What is the damage to the economy is that our high-paced growth rate of 7, which we wanted to go to 8 and 10, may not go, may slip back to 5, and may be there at 5, 5.5 for maybe 2 years. After which things will normal, the world comes back to normal, we'll come back to normal, we'll get back to a 6, 6.5, 7. And so the story of when we get to 10 may get delayed by another 5 years. That's it. So the structural story is still intact for these two reasons: the commitment of the government to capital expenditure and the people who are already born and are going to come into the workforce. That's India's structural story, and that is still intact. This government is not going to slip into, even through COVID, they still maintain their focus on capex. Please remember that. The worst of times. So I don't see anything. So this, when you say everything sell off India, that's the markets. It's not India economy. Everything sell off markets is because the significant amount, one point which I forgot to say earlier, a significant amount of the money is also passive index money, passive emerging markets index money, which gets sold off because the investor in the passive fund is selling off. So there is no choice of a sector. Why is India being sold? Because people are pulling money out of the equity markets. People are pulling money out of developed market funds and emerging market funds. So to the extent that passive funds get money pulled out, everything in the market in the passive index will get sold. So this everything sell off, reason wise, what? One is the passive component. Second is, like I said, oil hurts India. And third is currency depreciation hurts India. Now, none of these are permanent factors. When people again hunt for returns, look at the past crisis, global financial crisis and COVID. Both times the markets went through. In the COVID, it was a very short, sharp correction. In the global financial, it was a fairly long-ish correction. But when they bounced back, I'll remind you, what was the Sensex level pre-global financial crisis? 21,000. It fell to what? 8,000. Where is it today? 70,000. After the correction, 75,000. From 21,000 also, it's 3.5x. From 8,000, it's 10x. So what was that? The global financial was a structural hit to the world, right? Similar to the case with COVID. So my point is very simple: is everything sell-off is not a permanent sell-off. Everything sell-off is because right now we are collateral damage in this war of America, Israel, Iran. We are the bystander on the road who's got hammered because we have been buying the oil. So if you believe this is going to be a 3-year war and oil prices are going to be at $120 for 3 years, story is different. I don't believe that Iran will have the ability to last for 3 years on this war. This war is going to come to an end. I'm not going to put a time frame and say in a month or 2 months or 3 months. I don't know. But it's definitely not going to be a Russia-Ukraine kind of a situation, right? So believe in the fact that right now things are in a very despair. They are looking bad. You are looking at a tunnel and there is no light at the end of the tunnel. But know that you're in a tunnel. The tunnel has to end sometime. Okay? Just retain that faith. And like I said, based on those 4 parameters that I showed out to you, do your actions along that framework. Anything more, Kishore? There's been report that Russia has been selling gold. Can you share your views on whether this will have an impact on what you spoke of gold a short while ago? Well, one country selling gold, gold is already correcting. So impact means what? You think, will the correction be more because Russia is selling gold? Perhaps. See, unfortunately in gold, you can't take a very fundamental approach at all because there's no earnings to sit and say it's overvalued or undervalued. It's purely sentimental. But do you know one thing? On the one hand, you're saying Russia is selling this. But do you know one thing? Oil going from $65 to $110. Which country benefits the most? My dear friends, it's Russia. So don't forget that Glasnost and our own, the company which invests in India also is by SR. They bought SR. No. Okay. Okay. Nayara. They are raking in the money. So Russia, you are saying that gold was a short while back maybe, but now with the oil money coming into their coffers, and America saying, I lift the sanctions on using your dollar money. I don't see that their need to sell this gold will last for long. Right? So while Saudi Arabia may be complaining, quietly they're also laughing all the way to the bank on the oil prices. Okay. Then, since the DI is going to dry up eventually in the next few months, do we do a further wait and watch, push our investment to equity then? So DI is not going to dry up. So DIs will do tactical reallocations, and I don't think the SIP book is really going to collapse. They're going to continue to get about the 30,000 crores a month. So that buying power will be there. LIC and all that have bottomless. The government has been allocating more and more money from the EPFOs of the provident funds to do that. So knowing this, the government can even increase the allocation to equity because the markets have corrected, because they have to meet that 8.25 interest rate on the EPFO. So they will look at the correction and say, now is the time to add equity. So more money will come. Incrementally, fresh NPS and fresh allocations to provident fund by people will also, 20% of that is getting into equities. So don't worry about this DI going to dry up. All I said is this month they made a big investment of 1,12,000 crores because FIs was selling. They saw an opportunity and they also believed that the war is not going to last. But that is also, that's why they've done some sector rotations also to go and buy more of what they want. But it's not like it's going to dry up eventually, because DIIs are not just mutual funds, they're insurance companies, they're portfolio management companies, they're AIFs, and there are the father of them all, LIC, right? So that's not going to dry up. Is that they may not be able to sustain 1,12,000 crores next month also, but it's not going to dry up. It's not like that. Okay. Do we need to sell our gold investments so we have enough liquid to push into equity? Like, well, that's a call on which I leave Kaushik and Karthik. Sorry, I keep saying Kaushik and Karthik because a close friend of mine has two sons, Kaushik and Karthik. So when I talk to them as children, I always go there. So Kishore and Kaushik will guide you on that. Let me not take, because when you bought your gold, how much have you made in it? What is your total allocation? How much do they feel you should have in equities? Is there a chance to increase your equities? I leave it entirely based on your risk profile and assessment to both of them to say, rather than give a global answer for everything right now. 1 month of free cash flow be allocated for daily purchase recommended. Yes, absolutely. Right. Yes. If you had investments in developed markets, is it time to switch it from developed to developing economies? Not really. I don't think that the developed markets, if I remember, have corrected less than developing economies in this crisis, and they are more insulated also from these kind of well, their dependence on oil is there. They're also more insulated. So I would not recommend. Yes, there's tactical opportunity because this has corrected, but like I said, I don't believe that in a situation of geopolitical turmoil and panic, you should rebalance your portfolios, period. So after the war is over, you want to take a look at it, it's fine. But during the war, no, I would recommend just go back to the basics of what you've been doing for your long-term goal allocation. Stick to that through these tough times, right? That's what I'm saying. I'm not saying that that's the best strategy in terms of another strategy might give you more money, but I don't know the answer to which strategy will give you the more money. So rather than do that, stick to that nazar and sabr, right? Be patient with your allocation and have the vision and the focus. Different parts of your portfolio would have corrected to different levels, but how much they bounce back is not necessarily a function of that which has corrected more will bounce back more, right? So my recommendation even to Karthik and sorry, Kishore, not try to juggle around the portfolio too much in this period, okay, and to stick to the what they had done before the war, right? Though they are better at managing markets than me, so maybe they will do, but I'll leave it to them. This is my suggestion from my end on that tactically using the war to make a bet is very high risk. Okay, the right word I wanted was, it may give you a higher reward but comes at a higher risk. So do you want to do that at a time of uncertainty? You're adding another layer of risk to already a risk-based market situation. So don't double down on your risk, right, at such times. That's where I was coming from.
So that was today's episode. Thank you very, very much for listening in. We hope to see you soon. This podcast is intended to provide helpful and informative material on the subject matter covered. It is given with the understanding that the podcasters of this material are not engaged in rendering professional services through this program. If the listener requires personal assistance or advice, a competent professional should be consulted. The podcasters specifically disclaim any responsibility for any loss, liability, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use of any of the contents. The contents are general information that is intended to, but not guaranteed to be correct or updated. The information is not presented as a source of investment, insurance, or legal advice. You should not rely on the statements or representations made in this podcast or by any externally referenced sources. If you need investment or tax advice upon which you intend to rely in the course of your financial and business affairs, please consult a competent, independent, registered financial advisor. The content should not be taken as financial advice or as an offer to buy or sell securities, insurance, funds, or any financial products. It should not be taken as an endorsement, recommendation of any particular company or individual, and no responsibility can be taken for inaccuracies, omissions, or errors. The information presented is not to be considered as investment advice. The podcasters do not assume any responsibility for actions or non-actions taken by people who have listened to this program, and no one shall be entitled to claim for detrimental reliance or non-reliance upon any information provided or expressed herein. Your use of any information provided herein does not constitute any type of contractual relationship between yourselves and providers of such information. The podcasters hereby disclaim all responsibility and liability for all use of any information in this program.